International Business, Masters of Commerce, second semester, Mangalore University, session 6. International Business Environment. In this session, you are going to learn about the balance of payment. Learning objective to gain knowledge about the balance of payment. Session outcome the students are able to understand the balance of payment and know the major components of balance of payment. The term balance of payments is very often referred to in the news and is always a hot topic for political and economic discussions across the globe. The term balance of payments is used in various contexts. The balance of payment is an indicator of country's economic growth where the country has a favorable balance of payment. It indicates the economic prosperity of the nation. The deficit balance of payment indicates the country's underdevelopment. Sometimes the developed countries also may have deficit balance of payment. For example, the United States of America may have a deficit balance of payment because of huge assistance given to the poor countries. According to V. Sharon, balance of payments is a macro level statement showing inflow and outflow of foreign exchange. This means that it is a statement that records the flow of foreign exchange arising as a result of international economic transactions. International economic transactions include export and import of goods and services, unilateral transfers, foreign direct investments, foreign portfolio investments, etc., in and out of a country. A more comprehensive definition of balance of payments is provided by Kjol E. Yoon and Bruce G. Resnick. According to them, balance of payments can be defined as the statistical record of a country's international transactions over a certain period of time presented in the form of double entry bookkeeping. This definition shows that balance of payment statement has a time dimension, that is, it is prepared over a certain period which can be a quarter, a year, etc. Since balance of payment is a statement showing inflow and outflow of foreign currency in a country, all receipts from foreigners will be recorded as credit bearing a positive sign. Receipts accrue to a country in case of exports, it results in inflow of foreign exchange into the country. The sale of financial and real assets, likewise, all payments to foreigners will be recorded as the debit bearing a negative sign indicating an outflow of foreign exchange. Payment of foreign exchange arises due to import of goods and services, purchase of financial and real assets. Thus, inflow of foreign exchange is a positive entry and it is a credit. Outflow of foreign exchange, negative entry, and it is debited. The following is the receipts and payments account or the balance of payments account. In the first, under the credit side, the exports of goods or merchandises, services, and the income from foreign investments are recorded. And on the payment side, the imports of goods and services as well as foreign income from investments made at home will be recorded. On the receipt side, or the sales of long-term claims such as the equity claims, debt claims are credited, whereas the purchases of equity or the debt claims are debited. Sales of short-term claims such as again deposits and any other short-term claims will be credited, whereas purchases of long-term claims will be debited. Sale of goods will be credited, whereas the purchase of good is a payment item. Unilateral receipts will be credited, whereas the unilateral payments will be debited. Errors and omission in case of any which is related to either receipts or payments will be recorded accordingly. Balance of payment, a country's total exports of goods and services are the sources of receipts. In addition to this, it includes invisible services such as tourism, shipping, air transport, banking and insurance services, etc. Similarly, payments made to the other countries for the imports and other services are included in the payment side. Thus, there are two categories in the balance of payments accounts of a country. Payments in respect of exports and imports, which is including both visible and invisible items, and payments in respect of lending and borrowing. If during any period payments are greater than receipts, then the balance of payment is said to be deficit. If the country's payment are less than the receipts, then the balance of payment is said to be surplus. Balance of payment and balance of trade. Balance of payment and balance of trade means a country's balance of trade is different from its balance of payment. Balance of trade refers to the value of imports and exports of merchandise. Balance of payment includes not only the exports and imports but also the invisible items such as shipping, insurance, tourism, and other services. It includes all debit and credit items for which the country makes and recovers payments during a given period. The balance of trade is only a part of balance of payments. A favorable balance of trade refers to the surplus of exports over imports of goods and services. An unfavorable balance of trade refers to the excess of imports over exports. Next is the components of balance of payment. The balance of payment statement covers and records all types of international economic transactions that a country engages in over a certain time period. Based on the type of transactions, the balance of payment sub-accounts are as follows. The current account, the capital accounts, the statistical errors and discrepancies, the official reserves account. First one is the current account. The current account records all international economic transactions involving export and import of goods and services occurring within the current period. It has the following subcategories. First one is the goods or the merchandise trade. The export and import of goods is included in this subcategory of the current account. This is the most basic and traditional form of international economic transaction. The export of goods cause an inflow of foreign exchange into the country while the import of goods cause an outflow of foreign exchange from the country. Consequently, export of goods is recorded as a credit or positive item in the balance of payment statement, while the import of goods is recorded as a debit or a negative item in the balance of payment statement. The difference between the export and import of goods is also known as the balance of trade. If export of goods is more than the import of goods, the balance of trade is in surplus. On the other hand, if the import of goods exceed the export of goods, the balance of trade is in deficit. Second, services or the invisible trade. This subcategory of current account includes export and import of services. Services are intangible commodities. Since they do not have a physical substance, service trade is also known as invisible trade. Common internationally traded services are transportation, tourism, financial charges for banking and insurance, royalties for intellectual property rights, construction services, etc. The rendering or export of these services entitles a country to receipt of foreign exchange and is therefore recorded as a credit or a positive item. On the other hand, the utilization or import of these services creates a foreign exchange payment liability and is hence recorded as a debit or a negative item. This subcategory of the current account has recorded the fastest growth for many industrial countries in the last 2 decades. The third subcategory of current account is a factor income. This subcategory of current account includes income by way of interest and dividend on investments made abroad in previous periods. Example, if an Indian company sets up a subsidiary in Singapore, the proportion of net income of the subsidiary is paid to the parent company in India in the current period. It shall be treated as current investment income for India. Also, wages and salaries to non-resident workers shall be included in this subcategory. The fourth subcategory is the unilateral transfers. As the name suggests, this subcategory of current account includes one direction flows. Unlike exports and imports, unilateral transfers are unrequited or unreciprocated flow of funds. Hence, there is no offsetting flow against unilateral transfers. Flow of funds by way of gifts, remittances, pension, foreign aid, official and private grants, and other similar transfers against which No services are rendered or goods provided are included in this subcategory. Receipt of such transfers causes inflow of foreign exchange and is recorded as a credit or the positive item and vice versa. The debit and the credit side of the various subcategories of current account need to be balanced. If the credit side is bigger than the debit side, the difference is known as the current account surplus, and when the debit side is bigger than the credit side, the difference is known as current account deficit. A deficit in the current account is to be met by either of the following. First one, borrowings from foreigners or selling of past foreign investments. Now let us come to the second component of balance of payment, the capital account or the financial account. The capital account records all international economic transactions relating to investment in or withdrawal from financial assets and real estate. It reflects the flow of funds relating to international loans, investments, and banking funds. Investment in or purchase of financial and real estate abroad is recorded as a debit item in the capital account since it involves an outflow of capital. Likewise, sale of financial assets and real estate to foreigners is recorded as a credit item in the capital account since it results in receipt of foreign exchange. The first subcategory of capital account is a foreign direct investment. When a foreigner investor acquires 10% or more of the voting rights of a domestic business with an intent to control it, such an investment is called the foreign direct investment or FDI. Example, when the Japanese automobile manufacturer Honda built an assembly plant in Ohio, it made a foreign direct investment in Ohio. In the same way, acquisition of Carnation, a US firm, by the Swiss multinational Nestle Corporation amounted to FDI. Giant multinationals locating their production facilities in India, China, and other Asian countries to benefit from cheap labor also amounts to FDI. When a country receives FDI, capital flows into the country and it is hence recorded as a credit or a positive item in the capital account of the balance of payment. On the other hand, when a country makes FDI abroad, capital flight takes place, hence it is recorded as a debit or a negative item in the balance of payment. The second subcategory of capital account is a portfolio investment. This category of the capital account includes the sale and purchase of foreign financial assets such as bonds, stocks, money market instruments, financial derivatives, and the like, which does not cause a transfer of control. Purchase of Indian financial assets by foreigners causes an inflow of foreign exchange and hence it should be recorded as a credit or positive item in the balance of payment statement. Likewise, purchase of foreign financial assets by Indian causes a capital flight and hence should be recorded as a debit or the negative item in the capital account. In the same way, withdrawal of investment in the foreign financial assets by Indians causes an inflow of capital and withdrawal of investment in Indian financial assets by foreign causes an outflow of capital. Other investments. This subcategory of capital account includes transactions in trade, trade credit, currency, bank deposits, etc. The third subcategory of the capital account is errors and omissions. This is an item in the balance of payment statement. It is also known as statistical discrepancy. It is considered while arriving at the overall balance. The statistical discrepancy in the balance of payment arises due to the following reasons. First, difficulty in data collection. Data or the balance of payment statement is collected from different sources and these sources differ in their approach of data compilation. Hence, statistics from different sources vary, resulting in statistical discrepancy in the balance of payment statement. Second reason is the lead or the lag transactions. Movement of foreign exchange may lead or lag the transaction that they are financing. For example, if the goods are shipped in March 2019 and the payment for them is received in April 2019, the sent shipment will be recorded in the financial year ending 31st March 2014. However, 2019, However, the payment for it shall be recorded in the following financial year ending 31st March 2019. This difference leads to statistical discrepancy in the balance of payment statement. The third reason is estimates. The balance of payment uses estimates to arrive at certain figures relating to travel, tourism, etc., for which exact amounts are difficult to ascertain. Estimates are based on the samples. If the sample chosen is defective, the statistical discrepancy is bound to arise. The fourth reason is unrecorded illegal transactions. Once statistical discrepancy is identified, the overall balance can be arrived at. The balancing between all credits and debits in the current account, capital account, and the statistical discrepancies represent the overall balance. If the overall balance is in surplus, the surplus amount is used to repay borrowings from the IMF, and the balance, if any, is carried to the official reserves account. If the overall balance is in deficit, the monetary authorities of the country arrange for capital flows via drawings from the IMF or official borrowings, or by bringing down the official exchange reserves to make the deficit. Based on the above, capital account flows can be of two types: accommodating capital flows and autonomous capital flows. Accommodating capital flows or above the line capital flows is the inflow of capital meant to cover the overall balance of payment deficit. The objective of such flows is to bring the balance of payment statement into equilibrium. It usually includes drawings from the IMF. Autonomous capital flows or below the line capital flows is the inflow of capital which occurs regardless of any deficit in the balance of payment. For example, foreigners repaying loan, the FDI inflows in a country, etc. The, the fourth category of the balance of payment statement is the official reserves account. The official reserves account records monetary gold, SDR allocations to a country by the IMF, and foreign currency assets held by the monetary authorities of a country. If the overall balance of payment is in surplus, the surplus gets added to the official reserves account. If the overall balance of payment is in deficit, the official reserves account gets reduced by the deficit amount if accommodating capital flows are unavailable. Next is the system of balance of payment accounting. International economic transactions are recorded in the balance of payment in the form of double entry bookkeeping. Every credit has a corresponding and a matching debit entry and vice versa. This means that disequilibrium in the balance of payment does occur, however, not from the accounting point of view, since all credits are matched with the corresponding debits. Example, suppose that an export house in India exports garment worth rupees 10 million to the US, and the US pays it from its rupee bank account kept with India. Then the receipt of 10 million by USA will be recorded as a credit or a positive item in the current account, and its corresponding debit or negative entry will be in the capital account, showing a reduction in the Indian bank's liability. It should be noted that though balance of payment is based on the double entry bookkeeping system of accounting, however, individual transactions, that is the current and capital account entries, are recorded independently of one another. Hence, due to mistakes, errors and statistical discrepancies, the debit of the balance of payment may not match with its credit, and hence the overall balance may not balance. The balance of payment disequilibrium occurs when every surplus or deficit in it is eliminated. Practically, balance of payment is rarely in such equilibrium. It is either in surplus or in deficit. Several key macroeconomic variables interact with the balance of payment and cause disequilibrium or correct it. These variables are as follows: the gross domestic product or the national output and national spending; second, the money supply; third, the interest rate; and fourth, the exchange rate. Balance of payment and GDP. If a country's national income exceeds its national spending, the excess of national income over national spending will be invested abroad, giving rise to capital outflows. This shall cause a capital account deficit. On the other hand, if a country's national spending exceeds its national income, the gap shall lead to inflow of capital into the country, causing the capital account surplus. The gap between national income and national spending affects the capital as well as the current account. For example, if the national output is greater than national spending, the excess of output will be exported. This shall lead to a surplus in the current account. This is invested abroad, thereby causing the capital account deficit via capital outflows. Much the same way, if national spending exceeds national output, the gap is bridged via imports. These imports cause a current account deficit. The current account deficit is made good by borrowing from abroad. These borrowings come in the form of capital flow inflows which cause a surplus in the capital account. Second, balance of payment and money supply. An increase in money supply, if not accompanied with a proportional increase in output, causes an increase in the price level of inflation. People substitute the more expensive domestic products with cheaper foreign goods by importing them. This causes a current account deficit. Moreover, with inflation, exports turn uncompetitive in the global marketplace. This causes the export bill to fall further, enlarging the current account deficit. The reverse happens with the money supply in the economy reduces. The third is the balance of payment and interest rate. As the interest rate increases, the capital investment in the country become more attractive as they would now yield greater returns than in the rest of the world. This causes the capital inflows into the country which leads to a capital account surplus. In the same way, when domestic interest rate decreases, the foreign investments become more attractive than the investments in the home country. This causes capital outflows chasing greater returns abroad. This leads to a deficit in the capital account. The fourth is the balance of payment and exchange rate. In a fixed exchange rate regime, the onus of maintaining the exchange rate at a certain level lies on the government. If balance of payment disequilibrium arises, the government intervenes to correct it. If the balance of payment is in deficit, this means that there is excess supply of domestic currency in the international market than is demanded. The government in such a situation will buy the domestic currency from the international market and bring back the exchange rate at the previous level. This shall make imports expensive and exports competitive, causing the current account deficit to reduce to near zero level. Much the same way, if balance of payment is in surplus, this means that there is surplus demand for domestic currency in the international market. The government then intervenes in the market and sells domestic currency to correct the balance of payment surplus. Under the flexible exchange rate regime, the balance of payment disequilibrium theoretically adjusts the exchange rate in the direction required to fix it. For example, if a country has a balance of payment deficit, it implies that there is excess supply of domestic currency in the international market. With the supply of domestic currency being greater than the demand for it in the international market, the domestic currency faces depreciation by invisible market forces. A currency depreciation makes imports dearer and exports attractive. This corrects the balance of payment disequilibrium. The reverse happens in the case of balance of payment surplus. Under the managed float regime, the government plays an indirect role such as altering the relative interest rates in maintaining the exchange rate with a view to correcting the balance of payment disequilibrium. The balance of payment disequilibrium becomes a matter of worry when it is associated with the current account as it is not easy to correct it. A surplus balance of trade is not a very difficult situation as the surplus in it can be used to meet the deficit, invisible trade, or be invested abroad. But if the balance of trade faces a large deficit such that it cannot be covered by the invisible trade surplus, current account deficit arises. The accommodating capital inflows are not smooth and hence correcting the current account deficit is a difficult situation. If this deficit persists for long, a country's official reserves account will be eroded eventually and the country may soon find itself in a cruel debt trap. It is for this reason that the balance of payment disequilibrium correction measures aim to correct the imbalance in the trade account. The next is the causes for the disequilibrium in the balance of payment. The disequilibrium arises when the total amount payable to other countries on account of international transaction is not equal to the total amount receivable by the country. The causes for the disequilibrium in the balance of payments are given below. The main cause for the disequilibrium is the imbalance between the exports and imports of goods and services. The exports are small because of high cost and prices. When the prices of goods are high, exports are discouraged and imports are encouraged. Trade cycles also cause the disequilibrium. Fluctuations in the economic activity are shown as trade cycles. At the time of prosperity, the imports will increase due to the change in the income of the people. At times of depression, the exports will increase due to fall in the prices. The lack of capital available in the economy also causes disequilibrium in the balance of payments. When the domestic investment exceed the domestic saving, imports exceed the exports, thus changes in the economic growth and the demand for capital cause disequilibrium. Technological changes means innovations or inventions of new goods. The changes in technology affect the demand for goods and services. Innovation leads to an increase in exports and fall in imports. Structural changes in the economy also causes disequilibrium. For example, due to change in the crop pattern in India, jute production may fall. This results in fall in the Indian jute products. The balance of payment is affected by changes in the rate of foreign exchange. If the country's currency value increases, the import will become more cheap and exports become dearer. The imports will increase and exports decline. Thus, a change in the value of the currency causes disequilibrium in the balance of payment. Seventh, change in the price level causes disequilibrium in the balance of payment. Price changes may be inflationary or deflationary. Deflation causes surplus in the balance of payment. Surplus balance of payment does not cause serious concern from surplus countries' point of view unless it leads to wasteful expenditure and misallocation of resources. On the other hand, inflationary changes in the prices create deficit in the balance of payment. Deficit balances of payment result on increased indebtedness, depletion of gold reserves, loss of employment, distortion in the domestic economy, and causes serious problems in the deficit countries. The eighth is the other factors which may cause the temporal disequilibrium. First one is the seasonal disturbances or crop failure, particularly in the primary goods producing countries. Second, the rapid growth of population leading to a large scale import of food items. Third, the ambitious development projects requiring heavy imports of technological equipment, machinery, etc., and technical know how. Demonstration effect of advanced countries on the consumption pattern of people of less developed countries. So far, different types of causes such as price and cost, quantity of trade, national income, structural change, trade cycles, and rate of exchange are discussed. Now, measures to correct disequilibrium can be discussed. There are four important methods of correcting the disequilibrium in the balance of payment. The basic fact with the policymaker has to bear in mind is that under free trade system, deficit in the balance of payment arises mainly either because the aggregate domestic demand for goods and services is greater than total domestic supply, prices of domestic and foreign goods being comparable, or because domestic prices are significantly higher than foreign prices. Thus, the deficit may be removed in two ways: by increasing domestic production at an internationally comparable cost of production, or by reducing the excess demand. First one, export promotion and import restrictions. To encourage export, the cost of production has to be reduced. The wages and the interest rate should be reduced. The supply of money has to be reduced to bring down the prices. Export subsidies are granted to the producers to increase the exports. Imports are discouraged by the imposition of import duties and quota. Devaluation or exchange depreciation. Relative prices of import and export can be changed through the devaluation or exchange depreciation. While exchange depreciation refers to fall in the value of home currency in terms of foreign currency, devaluation refers to fall in the value of home currency in terms of gold. Devaluation and exchange depreciation change the relative price of import and export price. Relative and export price decreases not necessarily in the proposition of devaluation. Thus, if devaluation or exchange depreciation is effective, import decreases and export increases. Another method is to reduce the external value of the currency. When the home currency's value is reduced, the domestic goods become cheaper and exports prices fall. The prices of the imports will go up. This encourages export and discourages imports. Devaluation may not always be successful when the other countries also follow devaluation. Third, inflation. When the inflation is checked, the prices are lowered. The exports will increase and the imports decrease. This will correct the adverse balance of payment. Prices can be reduced by adopting fiscal and monetary measures. The fourth measure is the exchange control. Finally, exchange control method is used to correct the disequilibrium. Exchange control refers to a set of restrictions imposed on the international transactions and payments by the government or exchange control authority. Deflation is dangerous. Devaluation is a temporary method. Therefore, these methods cannot be used successfully. The government has to control the foreign exchange directly. All the exporters have to surrender the foreign currency to the government. Then, the government distributes the foreign currency to the licensed importers. Exchange control system as a measure of adjusting adverse balance of payment differs radically from the indirect corrective measures. While the latter works through the market forces of demand and supply conditions, the former works through artificial system created by arbitrary rules and regulations. Exchange control mechanism acts as the last resort in the hands of government under severe strain of balance of payment deficit. The exchange control is said to possess a superior effectiveness in providing solutions to the deficit problem. In short, the balance of payment disequilibrium can be corrected by the combination of the following methods: monetary and fiscal measures, exchange rate adjusted for with devaluation. Fourth is the trade restrictions, that is through tariff, quota, etc. The capital movement, that is borrowing or lending abroad. All the above methods can be applied depending upon the nature of disequilibrium. The importance of the balance of payment. The balance of payment gives a clear picture of the country's international transaction during a particular period. The balance of payment reflects the international financial position of the economy. It helps the government to take monetary and fiscal measures. The balance of payment serves as a very useful purpose insofar as it yields necessary information for the future policy formulation in regard to domestic monetary and fiscal policy and foreign trade policy. The balance of payment account provides extremely useful data to the economic analysis of countries' strengths and weaknesses as a partner in the international trade. It also reveals the charges in the composition and magnitude of foreign trade. The changes that are different to the economic well being of the country warrant necessary action by the government. It emphasizes the importance of international trade on the national income. For example, the developing countries depend upon the foreign countries for the economic development. The balance of payment is an indicator of country's economic growth. When the country has a favorable balance of payment, it indicates the economic prosperity of the nation. The deficit of balance of payment indicates the country's underdevelopment. Sometimes the developed countries may have also to deficit the balance of payment. For example, USA may have a deficit balance of payment because of the huge assistance given to the poor country. Thus, the country's balance of payment cannot be an index of the economic development. Thank you.